Okay, let's jump right into it. Have you ever looked at the financial markets? Maybe seen a stock price or thought about buying a bond and wondered, how did it even get here? Like, where do these securities actually come from before they show up on your screen ready for you to trade?
Yeah, it's easy to just see the trading part, right? The buying and selling. But there's this whole kind of fundamental process that has to happen first. It's the engine room, really.
Exactly. And that's what we're diving deep into today. We're lifting the curtain on, the fundamental process of how governments and corporations actually raise money, big money, and how they get their securities, things like stocks and bonds, ready for the public market.
It's like the pipeline.
Yeah, the pipeline that brings securities from the issuer, the company, or government right to your brokerage account.
And our source material for this deep dive, it gives us a really clear look at this process. It draws insights from material covering concepts around financing and listing securities. It lays out the players, the steps, and the rules.
Right. So our mission today is to take this often complex, highly regulated world, break it down piece by piece, explain the key concepts in simple terms, use the examples provided in the source to make it concrete, and ultimately help you feel a lot more informed and confident about how this whole system works.
Mm.
We really want to elaborate on each concept, make sure it's clear why it matters.
Okay, let's unpack this.
So right at the beginning of this whole thing is the need for capital. Companies need money, right, to expand, innovate, just run their operations day to day. Governments need money, too, for infrastructure, social programs, or maybe just to manage their existing debt load.
And this fundamental act of raising that capital is often called financing.
Financing, yeah. You'll also hear it referred to pretty often as underwriting, especially when we're talking about securities issues. They're closely related terms in this context.
And this isn't usually something these companies or governments do entirely on their own, is it? No, generally not for public markets. They work with expert financial institutions, specifically their investment dealer finance departments. These departments are like the crucial intermediaries. They stand between the entity issuing the securities, the government, or the corporation that needs the funds, and you, the investor, who has the capital to provide.
Okay, so they are the matchmakers, in a sense.
Kind of, yeah. And within these finance departments, the expertise is often split because, well, the needs and methods for governments versus corporations can be quite different.
How so?
Well, you've got one group focusing on government finance. They specialize in helping governments issue debt bonds, T-bills. They advise on every detail how much money the government should try to raise, the best timing considering market conditions, which currency makes sense.
Okay.
Even how the new issue might impact the market for existing government debt. They'll advise on things like, should they create a brand new bond or just add more to an existing one? That's called reopening a bond.
Right, reopening. And the other side?
That's corporate finance. Their challenge is a bit different. They're balancing the needs of a private company with the demands and expectations of public investors.
A trickier balance, maybe.
It can be. They advise companies on really fundamental choices. Should they issue stock, which is equity, or should they borrow money by issuing debt? What's the best timing for the market? Should they sell the securities privately, just to a few big investors, or go public and sell to everyone?
And who are they targeting? Big institutions or individual retail investors?
Exactly. That retail versus institutional split is a key decision. And then, critically, they advise on the pricing. What interest rate or dividend should it offer, if any? How should it be valued compared to similar securities already out there? And of course, the fee the dealer will charge for all this work.
It sounds like that advisory role is absolutely central.
Oh, it's critical. The dealer understands both sides. They know what the issuer needs: flexibility, enough capital, and they know what investors are looking for: potential return, the right risk level, a structure that makes sense. They help bridge that gap and design an offering that hopefully works for everyone involved.
Okay, so let's dig into how governments, specifically the Canadian federal government, actually raise this capital.
Yeah.
The source notes the main method for new federal bonds and treasury bills is the competitive tender system.
Right. Think of it like a formal auction.
An auction, okay. Who gets to bid?
Well, it's not open to just anyone off the street. Only a specific group of players are eligible. These are recognized government securities distributors. These are typically the major banks and large investment dealers who meet certain criteria set by the Bank of Canada.
And there's a subset called primary dealers.
Yeah, the primary dealers are a subset of those distributors who are the most active participants in the government debt market. They have specific obligations, but also certain privileges in the auctions.
Now, what if you're, say, a smaller investor or maybe a less active player. Is there a way in?
Yes, there's the non-competitive tender option. If you choose this route, you don't have to try and guess the winning yield like the big dealers do in the competitive bids.
So you don't have to bid a specific price or yield.
Exactly. Your bid for bonds or T-bills is simply accepted in full up to a certain limit, but you get them at the average yield of all the competitive bids that were successful in that auction. It's a way for smaller participants to get access without playing that high-stakes yield guessing game.
That seems fair. And these auctions, they happen regularly.
Well, yeah, very regularly. The schedule is predictable, which adds transparency to the market. For example, 2, 5, and 10-year bonds are usually auctioned quarterly, 30-year bonds maybe semi-annually. And if you buy a government bond, they're typically issued in nice, round $1,000 multiples. Makes it easier.
Let's make this really concrete. Can we walk through that government bond auction example from the source? I think that helps clarify how the competitive bids work.
Sure. So imagine the government wants to sell, say, $2.5 billion of new 10-year bonds. Various government securities distributors submit their competitive bids. Each bid says, I want this amount of bonds, and this is the specific yield I'm willing to accept.
Okay, so multiple bids, different yields. How does the government decide who wins?
Here's the key rule. They accept bids starting from the lowest yield first, and they work their way up.
Lowest yield. Why lowest? Doesn't the government want higher yields?
Think about it from the government's perspective as the seller of the bond. A lower yield for the investor means the investor is willing to pay a higher price for that bond today. The government wants to borrow money as cheaply as possible, which means selling its debt at the highest possible price. So lowest yield wins.
Got it. Lower yield equals higher price for the bond issuer.
Right.
Okay, so in the example, say 4 bidders submit the lowest yields, and they each bid for $500 million worth.
Right. That immediately accounts for $2 billion of the $2.5 billion total issue size. $500 million by 4 equals $2 billion. Now, let's also say there were $25 million worth of bids submitted using that non-competitive tender option we talked about. Those are set aside for just a moment.
Okay, so $2 billion allocated competitively, $25 million non-competitive weighting. The government still needs to sell another $500 million from the competitive pool, right?
$2.5 billion minus $2 billion.
Exactly. So they look at the bids at the next lowest yield level. Let's say bidder 5 bid for $500 million at this yield level. Now, according to the source example, bidder 5 wouldn't get the full $500 million they bid for.
Why not?
Because the government first needs to make sure those non-competitive bids are filled. So from that remaining $500 million available competitively, they first allocate the $25 million needed for the non-competitive tenders.
Okay. So bidder 5 gets the remainder.
Right. Bidder 5 would get $475 million, $500 million available minus the $25 million needed for the non-competitive bids.
And what about those non-competitive bidders? They get their bonds. Yes, they automatically get their full $25 million worth of bonds. But remember, their yield isn't the specific yield they bid, since they didn't bid one. Their yield is the average yield across all the competitive bids that were accepted up to that final cutoff point.
And anyone who bid a yield higher than that cutoff yield,
they get nothing in this particular auction. It's a very structured process, driven by price or yield, especially for the big competitive players.
that makes sense.
Yeah.
Now, what about provinces and municipalities? Do they use the same auction system?
Often, no. They use slightly different approaches. Provincial bonds, for instance, are often sold through a negotiated price. The province sits down with a financial institution that acts as their fiscal agent, and they agree on the terms. These deals frequently involve a syndicate.
A syndicate, what's that?
It's just a group of investment dealers and banks that band together. They pool their resources and contacts to underwrite or guarantee the sale of and distribute the large provincial issue. Spreads the risk and increases the selling power.
Okay. And municipalities, like cities.
They often place their bonds and debentures directly with large institutional investors, think big pension funds or insurance companies. Less of a public auction, more of a direct sale to a few big buyers.
Okay, let's shift gears then. From government financing to the corporate world. How do companies raise their capital? You mentioned it's often a negotiated offering.
That's right. Unlike the federal government's auction, corporate financing usually involves the company seeking capital, sitting down with an investment dealer, maybe their lead underwriter, and they basically hash out all the terms together.
Like what kind of security, the exact price, the interest rate, any special features?
Protective provisions for investors, all of that. It's generally a more collaborative, customized approach compared to a standardized government auction.
And corporations have 2 main ways to raise this capital, right?
Fundamentally, yes. Equity financing and debt financing.
Okay, break those down simply.
Sure. Equity financing is basically selling ownership in the company. When you buy a stock or a share, you're buying a small piece of ownership in that company. You become a part owner.
Right, and debt financing.
Debt financing is essentially borrowing money. When a company issues a bond or a debenture, it's taking out a loan from investors. When you buy that bond, you're lending the company money. They promise to pay you interest over time and then eventually repay the principal loan amount. Ownership versus loan. That's the core difference.
Let's zoom in on the equity side first, shares. There are a few key terms the source highlights that describe a company's stock. They seem important to get straight. First up, authorized shares.
Right. Authorized shares represent the absolute maximum number of shares a company is legally allowed to issue according to its original charter or incorporation documents. It's like the ceiling set when the company was formed or legally structured.
So the source mentions ABC Inc. being authorized to issue 10 million common shares. Does that mean they sell all 10 million right away?
Not necessarily, and often they don't. They might only issue a portion initially, say 6 million shares. They keep the remaining 4 million authorized but unissued. This gives them flexibility for the future.
Flexibility how?
Well, they might need to raise more capital later for expansion, or maybe they want shares available for an acquisition, or for employee stock option plans. Having those authorized but unissued shares means they don't have to go through the whole legal process of increasing their authorized limit later on.
Okay, that makes sense. So authorized is the max allowed. What are issued shares then?
Issued shares are the number of authorized shares that the company has actually sold and delivered to shareholders at some point. This includes shares sold in the initial public offering, IPO, any later offerings, or shares given out through stock options or employee plans. They've left the company's treasury and gone out into the world.
All right. Then there are outstanding shares. How is that different from issued?
This is a key distinction. Outstanding shares are the issued shares that are currently held by anyone outside the company itself. This means shares held by the general public, big institutional investors like pension funds, and even company insiders like executives or founders. These are the shares that actually trade back and forth on the stock market day to day. They typically carry voting rights and are entitled to receive dividends if the company pays them.
Okay. Issued means sold at some point. Outstanding means currently held outside the company. What about treasury shares? That sounds a bit different.
It is. Treasury shares are shares that the company had issued in the past but has since bought back from the market, maybe through a share buyback program.
So the company owns its own stock.
Exactly. While the company holds these shares in its treasury, they are not considered outstanding. They don't have voting rights, they don't receive dividends. Think of them as being temporarily taken out of circulation.
Why would a company do that? Buy back its own shares.
Several reasons. Maybe they think the stock is undervalued. Maybe they want to return cash to shareholders without paying a dividend, or perhaps reduce the number of shares outstanding to boost earnings per share. The key point is that buying back shares reduces the number of outstanding shares.
Right, and understanding outstanding shares is crucial for something called market capitalization, or market cap.
Absolutely. Market cap is the total dollar value the stock market places on a company. It's a very common metric. You calculate it simply by taking the number of outstanding shares and multiplying it by the current market price per share.
Okay, let's use those examples from the source again. Example 1, ABC Inc., authorized, 10 million shares, issued, 6 million. But they bought back 150,000 shares, which are now treasury shares.
Right. So to find the outstanding shares, you take the issued shares, 6 million, and subtract the treasury shares, 150,000. That gives you 5,850,000 outstanding shares.
And if the market price is, say, $10 per share?
Their market cap is 5,850,000 shares times $10 per share, which equals $58,500,000.
Simple enough. And example 2, DEF Inc., authorized 1.5 million, issued 1 million. And the source says all issued shares are outstanding.
So in this case, no treasury shares. The number of outstanding shares is just the 1 million issued shares. If the price is also $10, their market cap is 1 million shares times $10, which is $10 million. These examples really highlight why you need the outstanding number, not just issued, especially if there are treasury shares involved.
Makes sense. One more term related to shares, public float. What's that about?
Public float is a refinement of outstanding shares. It represents the portion of the outstanding shares that are genuinely available for trading by the general public on the open market.
So it excludes some outstanding shares. Which ones?
It typically excludes large blocks of shares held by company insiders like founders, executives, Major strategic corporate shareholders, or sometimes governments, basically, shares held by parties who are unlikely to be actively trading them on a daily basis because they're holding them for control or long-term strategic reasons.
Okay. So the source uses GHI Inc. as an example. 6 million outstanding shares. But 2.2 million are held by insiders or large institutions for control purposes.
Right, so the public float would be the 6 million outstanding minus the 2.2 million held by those control groups. That leaves a public float of 3,800,000 shares. These are the shares truly circulating among public investors.
And why does the size of the public float matter to investors?
Because a smaller public float can potentially lead to higher stock price volatility. Think about it. If there are fewer shares readily available for buying and selling, any significant buy or sell order can have a much bigger impact on the price, pushing it up or down more dramatically than for a company with a huge number of shares freely trading.
It's basic supply and demand, but amplified when the freely available supply is smaller.
Exactly. It can also affect liquidity, how easy it is to buy or sell shares without significantly moving the price. A smaller float can sometimes mean lower liquidity.
Okay, good to know. Let's switch back to the other main type of financing, debt. You said this is basically borrowing money.
Right. The company borrows money and promises to repay it, usually with interest payments along the way. The source focuses on two main types of public corporate debt securities: mortgage bonds and debentures.
What's the difference there? Mortgage bonds sound like they're related to property.
They are. With mortgage bonds, the loan is secured by specific assets owned by the company. Very often this is real estate land, buildings, or maybe other significant physical property like equipment.
So if the company can't pay,
If the company defaults on its payments, the holders of the mortgage bonds have a direct legal claim on those specific assets that were pledged as security. They get first dibs on those assets to recover their investment.
okay, that sounds safer for the investor. What about debentures?
Debentures are different because they are unsecured. They are backed only by the company's general creditworthiness and its overall pool of assets, not by specific pieces of property pledged as collateral.
So no specific asset backing them up.
Correct. They are essentially a loan based on the company's general promise to pay. If the company defaults, debenture holders are considered general creditors. They have a claim on the company's assets, but only those assets that are not already pledged to secured creditors, like mortgage bond holders. And their claim comes after those secured creditors are paid.
So mortgage bond holders get paid first from specific assets, then maybe debenture holders get something from whatever's left over.
That's the general idea in a bankruptcy scenario, yes. It means mortgage bonds are typically seen as less risky than debentures from the same company.
The source also mentions other ways companies borrow, like bank loans or commercial paper.
Yeah, those are other options. Bank loans are direct borrowing from a bank. Commercial paper is a type of short-term unsecured debt, often used by large corporations for short-term funding needs. But for public market debt securities, mortgage bonds and debentures are the main ones discussed.
Got it. Let's circle back to the investment dealer's role. We talked about their advisory function. It sounds pretty extensive.
It really is. When a company decides it needs to raise capital, the dealer doesn't just handle the mechanics. They provide a lot of strategic advice. We mentioned timing, the amount to raise, the pricing,
Right.
but also how best to distribute the securities to reach the right kind of investors, and crucially, providing support in the secondary market after the initial sale is complete to help ensure smooth trading.
And part of this involves the dealer doing due diligence.
Absolutely essential. Before a dealer agrees to underwrite an issue, especially on a firm commitment basis where they take the risk, they conduct a thorough investigation of the company. They dig into its business, its management team, its position in the industry, its financial history and projections, and especially the risks involved.
Why is that so important for the dealer?
Well, partly to protect themselves, to make sure they understand what they're potentially buying and selling, but also it's crucial for pricing the issue correctly and for preparing the disclosure documents, like the prospectus. They need to understand the company inside and out to advise effectively and fulfill their regulatory obligations.
And sometimes this leads to the dealer becoming the broker of record.
Yeah, if a dealer builds a strong relationship with a company through successful financings and good advice, they might become the company's preferred partner, their broker of record. This usually gives that dealer the first opportunity to handle any future financings the company undertakes.
Now, a huge piece of advice the dealer provides is on the type of security to issue. We touched on equity versus debt, but the source goes into specific pros and cons for each type.
Exactly. It's a critical decision, and the dealer helps the company weigh these trade-offs based on its specific circumstances, its financial health, its growth plans, its existing capital structure, market conditions, everything.
Okay, let's look at bonds for secured debt, like mortgage bonds. What are the advantages for the issuing company?
Generally, a potential advantage is a lower interest cost compared to unsecured debt like debentures. Because they're less risky for the investor due to that specific asset backing, the company might be able to borrow at a slightly lower rate. They're also often very marketable to large institutional investors who prefer or even require secured investments.
And the downside?
The main disadvantage is reduced flexibility. Pledging specific assets ties them up. It can make it harder to sell those assets later or complicate things if the company wants to merge with another firm. And like all debt, those required regular interest payments create a default risk if the company hits a rough patch financially.
Okay. What about debentures, the unsecured debt? Pros?
The big pro is flexibility. Since no specific assets are pledged, the company retains more freedom in managing its assets. The source also notes they can sometimes have lower issue costs because you avoid the complexity and expense of appraising and legally registering specific pledged assets as collateral. The main con is typically a higher interest rate or coupon. Because they're unsecured and riskier for investors, the company usually has to offer a higher yield to attract buyers compared to secured bonds. And of course, they still carry that same default risk from the mandatory interest payments.
Right. Now, preferred shares. These are kind of a hybrid, right? Equity on the books, but with fixed dividends like debt.
Sort of, yeah. An advantage is that they count as equity on the balance sheet, which can improve the company's debt-to-equity ratio, possibly making it easier to borrow more regular debt later. Also, crucially, missing a preferred dividend payment doesn't automatically trigger default or bankruptcy like missing a bond interest payment does.
But there must be consequences.
Oh, yes. It damages the company's reputation, and often, if preferred dividends are missed for a certain period, the preferred shareholders might gain voting rights they didn't have before, potentially impacting management control. Another pro is financing flexibility without pledging assets, and they can sometimes be structured with a limited life if they are redeemable by the company.
And the disadvantages of preferred shares.
They can be quite costly. The biggest issue is that dividends are paid from the company's after-tax income, whereas interest payments on debt are usually tax-deductible. This makes preferred dividends significantly more expensive in real terms than interest. We mentioned the potential for voting rights if dividends are missed. Also, some preferred issues have features like a purchase fund, which requires the company to set aside money regularly to buy back a certain amount of the preferred shares. This can be a drain on cash flow, especially when times are tough.
Okay, that's a lot to weigh. Finally, common shares basic stock. What are the advantages for the company raising capital this way?
Some major ones. First, there's no obligation to pay dividends. The company decides if and when to pay them based on profitability. Second, there's no requirement to repay the principal amount invested by shareholders. It's considered permanent capital for the company.
So less mandatory cash drain compared to debt or preferreds.
Exactly. Also, having a larger base of common equity generally makes it easier for the company to take on more debt in the future. Lenders like to see a solid equity cushion. And issuing shares publicly establishes a visible market value for the entire company, which can be useful for various reasons.
What are the downsides then? Why not always issue common stock?
The big one for existing shareholders is dilution. When a company issues new common shares, the ownership percentage of all the existing shareholders goes down. Each share represents a smaller piece of the pie. Also, if the company does choose to pay dividends on common shares, remember those dividends come from after-tax profits, making them more expensive than tax-deductible debt interest. And finally, the costs associated with underwriting and issuing common shares. The dealer fees, legal, accounting are typically higher than for issuing debt.
So lots of trade-offs. The dealer also advises on something called protective provisions or covenants.
Yes, these are really important, especially for debt issues like bonds and debentures, and particularly when the issuing company isn't considered super financially strong. Covenants are essentially rules or restrictions written into the legal agreement governing the security, usually found in a document called a trust deed or trust indenture.
What kind of rules?
They act as safeguards for the investors, the security holders. They might require the company to maintain certain financial ratios, like keeping its debt below a certain level relative to its equity. They might restrict the company's ability to sell off major assets or limit how much it can pay out in dividends to common shareholders, or require the company to keep certain assets free of liens.
The goal being to prevent the company from taking actions that could weaken its ability to repay the debt.
Precisely. Stronger covenants offer more protection for investors. Weaker companies often have to agree to more restrictive covenants to convince investors to buy their bonds or debentures. The dealer helps negotiate these terms to balance the company's need for operational flexibility with the investor's need for security.
Okay, once the type of security is designed, how does the company actually sell it? One method is a private placement.
Right. A private placement is when the issuer sells the entire issue of securities directly to a small number, maybe just one or a handful, of large, sophisticated institutional investors. Think big banks, insurance companies, pension funds, large mutual funds.
And why do this instead of a public offering?
A key reason is speed and cost savings. Because these buyers are considered sophisticated, they have the resources and expertise to do their own deep analysis of the investment regulators, often waive the requirement for the company to prepare and file a detailed public prospectus.
Avoiding the prospectus saves time and money.
A lot of time and money, potentially. Preparing a prospectus involves significant legal, accounting, auditing, and printing costs, plus the time delay of regulatory review. A private placement can often be completed much more quickly and cheaply.
But the downside is you're selling to fewer investors.
Yes, and often you might have to offer slightly better terms, like a higher yield, to compensate those few large buyers for taking down the whole issue and potentially having less liquidity compared to a publicly traded security.
Okay, the alternative is a public offering, selling to the general public through dealers. The source mentions two main types of agreements here, which seem to hinge on who takes the risk.
Exactly. This is a crucial distinction. The first type is a best efforts agreement.
Best efforts. Sounds like the dealer just tries their best.
That's basically it. Here, the investment dealer acts purely as an agent for the issuing company. They agree to use their best efforts, their sales network, their expertise to sell the securities to the public at the agreed price. But if they can't sell all of the securities by a certain deadline,
That happens.
the unsold securities are simply returned to the issuer. The dealer doesn't have to buy them. In this case, the issuer bears the risk that they might not raise all the capital they were hoping for if the market isn't receptive.
Okay, so issuer risk. What's the other type?
The second, and typically used for larger, more established companies or more significant issues, is a firm commitment agreement. This is often called a bought deal in Canada.
Odd deal. Sounds like the dealer buys it.
They do. In this scenario, the underwriter, the investment dealer, or group of dealers acts as a principal, not just an agent. They commit to buying the entire issue of securities from the issuer at a predetermined price and on a set date.
So the issuer gets their money guaranteed.
Exactly. The issuer gets a firm commitment for the capital they need. But now the underwriter owns the securities and takes on the full risk of reselling them to the public.
What if the market price drops before they can sell them all?
The underwriter loses money. They bought the securities at price X from the issuer, but now they have to sell them in the market at price Y, which is lower. That's the risk they take in exchange for their underwriting fee or spread.
That sounds significantly riskier for the underwriter.
It is. That's why bought deals are usually done for issues where the underwriters are pretty confident they can resell them quickly, often for well-known companies or standard types of securities.
The source also mentions different groups involved in large firm commitment deals, financing, banking, selling groups.
Yeah, for very large deals, especially bonds, the lead underwriter might syndicate the risk. The financing group, often just the lead managers, takes the biggest chunk of the liability. The banking group includes other dealers who also commit to buying a portion of the issue and share in the risk. And the selling group consists of dealers who just help sell the securities to their clients but don't actually take on any of the underwriting liability or risk themselves. It's a way to manage risk and broaden distribution.
Okay. Now, when we talk about offerings, there's also primary versus secondary. What's that distinction?
A primary offering involves the sale of new securities that are being issued directly from the company's treasury. The money raised from selling these securities goes to the company itself, increasing its capital.
And an IPO, an initial public offering.
An IPO is just a specific type of primary offering. It's the very first time a private company sells its shares to the general public, hence initial. All IPOs are primary offerings because they involve new shares being issued by the company.
Okay, so what's a secondary offering then?
A secondary offering is the sale of existing shares that are already issued and outstanding. These shares are being sold by current shareholders, maybe large institutional investors, founders, or early venture capitalists who want to cash out some of their holdings.
So the money doesn't go to the company in a secondary offering.
Correct. The proceeds from the sale go to the selling shareholders, not to the company's bank account. It doesn't raise new capital for the company, although it can increase the public float and liquidity of the stock by getting more shares into the hands of public investors.
And what about those treasury shares we talked about earlier, the ones the company bought back? Can they be sold again?
Yes, the source notes they can be resold later. If a company resells shares it held in its treasury, that would technically be another type of offering, putting previously issued shares back into the market. The money would go to the company in this case.
All right, now let's get into the real mechanics of bringing securities to the public market. This involves a heavily regulated process, largely governed by the prospectus system.
That's right. This is really the cornerstone of public market regulation in Canada and many other places. The fundamental principle is if you are undertaking a public distribution of securities, meaning selling them broadly to the general public,
You need a prospectus.
you typically need to prepare and file a prospectus with the relevant provincial securities regulators unless you qualify for a specific exemption.
And what is the core purpose of this prospectus? Why is this so important?
Investor protection, plain and simple. The law requires that the prospectus must provide full, true, and plain disclosure of all material facts relating to the securities being offered.
Okay, material facts. What exactly does that mean?
A material fact is generally defined as any piece of information that could reasonably be expected to have a significant effect on the market price or the value of the security. It's the information an investor would reasonably need to make an informed investment decision.
So basically anything important about the company, its business, its finances, the specific securities being sold, and crucially, the risks involved.
Exactly. Everything significant has to be laid out clearly, honestly, and in language that's understandable. It's not supposed to be a promotional document, it's a disclosure document. This transparency is key to maintaining public confidence and the integrity of the capital markets.
When does this prospectus requirement generally apply?
It applies most obviously to new issues of securities coming from the company's treasury, like an IPO or subsequent offerings. It also typically applies to sales of large blocks of shares by people who control the company because a change in control is a material event. And sometimes it applies even to resales of securities that were initially sold under an exemption if they haven't been seasoned in the market long enough.
Okay, so how does the process work? It starts with a preliminary prospectus.
Yes. The company and its underwriters first prepare and file a preliminary prospectus with the securities commissions. This document contains most of the required information, but some details, like the final offering price and underwriting fees, are usually omitted at this stage.
And it's often called a red herring prospectus.
That's right. It gets that nickname because it traditionally had a warning printed in red ink on the cover page.
What does the warning say?
It clearly states that the document is preliminary, it's still subject to completion or amendment, the securities regulators haven't approved it yet, and crucially, that the securities cannot legally be sold until a final prospectus is filed and receipted.
So what's the point of the preliminary prospectus then, if you can't sell with it?
It's used primarily to gauge investor interest in the potential offering, while the securities commissions review the filing. The underwriters can distribute the red herring to potential institutional and retail investors to see what the demand might be like. This helps them determine the appropriate final price for the offering.
Okay, so it's like a test balloon. And the time between filing the preliminary and getting approval for the final is called the waiting period.
Correct. And there are very specific rules about what the underwriters and dealers can and cannot do during this waiting period.
What can they do?
They can contact potential buyers and solicit expressions of interest, basically asking if they might be interested in buying if and when the deal becomes final. They must provide anyone they solicit with a copy of the preliminary prospectus. They can also place limited advertisements stating that the preliminary prospectus is available, maybe giving an expected price range, and providing the dealers contact information.
And what can they not do?
They absolutely cannot accept payment for the securities or enter into any binding agreement to purchase the securities. No actual sales can occur, no contract signed. It's strictly a period for information dissemination and gauging interest, not for closing deals.
The source also mentions something called a green sheet during this period.
Yeah, a green sheet is typically an internal document prepared by the lead underwriter for their own sales force and for other dealers in the selling group. It's a concise summary highlighting the key features, selling points, and important information about the new issue, designed to help the sales reps understand the deal quickly and talk about it effectively during the waiting period.
Now, Canada has multiple provinces, each with its own securities regulator. Does a company have to file the prospectus in every single province where it wants to sell?
Thankfully, no, not usually anymore. Most provinces and territories participate in the passport system. This system is designed to streamline the process.
How does it work?
Under the passport system, the issuer files their prospectus with just one regulator, known as their principal regulator, usually the one in their home province or where their head office is. That principal regulator reviews the prospectus on behalf of all the participating jurisdictions. Once the principal regulator issues a final receipt for the prospectus,
It's automatically accepted everywhere else.
essentially, yes, it's automatically deemed to be receipted or approved in all the other passport jurisdictions where the issuer indicated they want to sell. This avoids costly and time-consuming duplicate reviews, making it much easier and faster for companies to raise capital across Canada. Ontario plays a key role, often acting as the principal regulator for many national offerings.
Okay, that makes sense. So after the review period, assuming everything is satisfactory, the issuer files the final prospectus.
Correct. This is the definitive, legally binding disclosure document. It contains all the finalized details that might have been missing from the preliminary version, the exact offering price, the number of securities being sold, the underwriter's commission or spread, the final details on how the company plans to use the proceeds, and of course, all the required full, true, and plain disclosure of material facts, updated as necessary.
And it needs consent from experts.
Yes, if the prospectus include or refers to reports, opinions, or statements made by experts like auditors providing financial statements, engineers valuing assets, or lawyers giving legal opinions, the final prospectus must include written consent from those experts allowing their work to be used in the document.
Once the securities regulators give their final stamp of approval, issuing a receipt for the final prospectus, the issue is said to be blue-skied.
That's the term, yeah. Blue Sky means it has cleared the regulatory hurdles and the securities can now legally be sold to the public.
And then the final prospectus has to be delivered to everyone who buys.
Yes, there's a delivery requirement. A copy of the final prospectus must be delivered or sent to each purchaser of the securities within a specific time frame, typically by midnight on the second business day after the purchase agreement is made.
Let's look at the contents of that final prospectus. The source lists several key parts. The cover page seems really important.
It is. The cover page has to prominently display certain key information. The name of the company, the type and number of securities being offered, the price per security, the total value of the offering. It also has to disclose the underwriter's commission and any other payments being made to people involved in the offering. And very importantly, it must disclose if there's a market out clause.
Okay, what exactly is a market out clause? You mentioned it relates to bought deals.
Right. It's a provision sometimes included in the underwriting agreement, especially for those firm commitment or bought deals where the underwriter takes on the market risk. This clause basically protects the underwriter. It allows the underwriter to terminate the agreement and cancel the offering without penalty if certain specific, significant adverse events occur in the market between the time the deal is priced and the time it's scheduled to close. Things like a major stock market crash, a declaration of war, a banking moratorium, or some other catastrophic event that fundamentally changes market conditions.
So it's like an emergency exit hatch for the underwriter if the whole market tanks unexpectedly.
That's a good way to put it. It protects them from being forced to buy the securities from the issuer when the market they need to sell into has collapsed due to unforeseen external circumstances. Because it shifts some risk back to the issuer in those extreme cases, its existence must be clearly disclosed right on the cover page of the prospectus.
What else is typically in the prospectus?
You'll find a summary of the offering, detailed information about the issuer's business operations, its properties or assets, its financial condition, with audited financial statements, management discussion and analysis, MD&A, and a thorough discussion of the risk factors investors should consider. There's also information about the specific terms of the securities being offered, details about the company's directors and officers, major shareholders, and finally, signed certificates from the company's CEO, CFO, and representatives of the underwriters, all attesting that, to the best of their knowledge, the prospectus contains full, true, and plain disclosure.
That sounds incredibly comprehensive. Is there a way to speed this up for companies that are already public?
Yes. For established companies that are already publicly traded and meet certain qualifications, they're referred to as qualified. Reporting issuers, there's a streamlined process available called the short-form prospectus system.
Short form, how does that work?
It allows these qualified companies to access the capital markets more quickly and efficiently. Instead of preparing a full, long-form prospectus repeating all the detailed company information, the short-form prospectus focuses primarily on the specifics of the new securities being offered: price, terms, use of proceeds, etc.
Where does the rest of the company information come from then?
It works by allowing the issuer to incorporate by reference information that they have already publicly filed as part of their ongoing continuous disclosure obligations.
Okay, what's continuous disclosure?
Continuous disclosure refers to the legal requirement for all companies that are publicly traded or have issued securities to the public, reporting issuers, to keep the public informed about their affairs on an ongoing basis. This includes filing regular financial statements, quarterly and annual, issuing press releases about any material changes or events as they happen, and filing an annual information form, AIF.
What's an AIF?
The AIF is a comprehensive annual filing that provides detailed background information about the company, its business, operations, assets, and risks, much of the same type of information found in a long-form prospectus.
So the short form prospectus basically says, here are the details of this new offering, and for all the background stuff on the company, go read our AIF and other recent filings.
That's the essence of it, yes. It relies on the fact that the market already has access to extensive, up-to-date information about the company through its continuous disclosure record. This makes the short-form process much faster and less costly.
Are there conditions to using the short form?
Yes, the source lists several. The company generally needs to be filing its documents electronically on Cedar Plus in Canada, be a reporting issuer in good standing in the relevant jurisdictions, have current financial statements and an AIF already filed, not be considered an inactive company, like a shell company, and typically have its equity shares listed on an eligible stock exchange.
But some offerings still require the full long form.
Absolutely. A full long-form prospectus is still required for all initial public offerings, IPOs, because a private company going public doesn't have that existing public disclosure record. It's also generally required for offerings by companies that don't meet the short-form eligibility criteria, like inactive issuers.
Okay, so the prospectus is filed, the deal is blue-skied, the securities are sold in the primary market, then they start trading in the secondary market on the stock exchange or bond market. Sometimes the lead dealer steps in again here with aftermarket stabilization.
That's right. Particularly after a significant stock offering, like an IPO or a large secondary, the lead underwriter might engage in activities designed to support the securities price in the secondary market right after the issue begins trading. This is permitted by regulators as long as the possibility of stabilization activities was disclosed in the prospectus.
Why do they do this? Is it manipulating the price?
The stated purpose isn't manipulation in a negative sense, but rather to help ensure an orderly market for the newly issued security. The goal is to prevent excessive volatility or a sharp price drop immediately following the offering, which could undermine investor confidence in the issue and the process. It's about facilitating a smooth transition from the primary offering price to secondary market trading.
How do they actually stabilize the price? The source mentions a few methods. The main one seems to be the green shoe option.
Yes, the green shoe option, also known formally as the over-allotment option, is a very common tool. It's named after the Green Shoe Manufacturing Company, the first company to use it.
How does it work?
It gives the underwriters the option, but not the obligation, to sell more shares to the public than the original offering size specified in the prospectus. Typically, this over-allotment is around 15% of the base offering size.
So they sell extra shares they don't technically have yet.
Effectively, yes. They create a short position initially by selling these extra shares. How this helps stabilize depends on what happens to the stock price after trading begins.
Okay, scenario one. Demand is strong, and the stock price rises above the offering price. What do the underwriters do with their green shoe option?
In this case, they exercise the option. They buy those extra 15% shares directly from the company at the original offering price. They then deliver these shares to the investors they sold the over-allotment to. This covers their short position, the result. The company ends up issuing and selling more shares and raising more capital than originally planned, and the strong market demand is partially met without the price necessarily spiking too dramatically.
Okay, that makes sense for strong demand. Scenario 2. Demand is weak, and the stock price falls below the offering price after trading starts. Now what?
Here's where the stabilization comes in. The underwriters do not exercise the green shoe option to buy shares from the company. Instead, they use the proceeds they received from initially selling that 15% over allotment, which created their short position, to go into the open market and buy back shares at the lower market price.
Buying shares in the market, that would support the price.
Exactly. By buying shares, they create additional demand in the market, which helps to cushion the price decline. They continue buying shares back until they've repurchased enough to cover the short position created by the overallotment. This buying activity helps stabilize the price, ideally keeping it from falling too far below the original offering price. It's a clever mechanism using supply and demand.
Are there other stabilization methods mentioned?
Yes, briefly. A penalty bid is where the lead underwriter can financially penalize other dealers in the selling syndicate if their clients immediately sell or flip the shares they just bought in the offering back into the market, especially if the issue is trading weakly. It discourages that quick selling pressure.
And a stabilizing bid.
A stabilizing bid is simpler. It's just when the lead underwriter publicly posts a bid in the market to buy shares at or just below the offering price. This can only be done if the entire distribution hasn't been fully completed yet and it directly supports the price level.
Okay. Beyond these main public and private offerings, the source notes a few other ways securities come to market, especially for smaller companies, like junior company distributions.
Right. This term often refers to financings done by smaller, typically early-stage companies. Often in the resource sector, think mining exploration or junior oil and gas firms. These companies might not have significant revenues or earnings yet, so they're raising what's called risk capital.
High risk, potential high reward.
Exactly. Investors understand the speculative nature. These distributions usually involve the company selling new shares from its treasury, often through an investment dealer acting as underwriter or agent. Similar to a regular offering, but maybe under slightly different rules or exemptions depending on the exchange they're listed on, like the TSX Venture Exchange.
Junior companies might also issue options of treasury shares.
Yes, sometimes as part of a financing deal or as compensation, junior companies might grant options to buy treasury shares in the future at a set price. This is often an incentive for underwriters, brokers, or consultants assisting with the financing.
And escrowed shares, what does that mean?
Escrowed shares are shares that are issued but are then placed under the control of a third-party trustee for a certain period. They cannot be sold, transferred, pledged, or sometimes even released from escrow without specific approval from regulators or the stock exchange.
Why would shares be put in escrow? Locked up like that?
It's very common when shares are issued as payment for non-cash assets, especially for junior resource companies acquiring mineral properties or tech companies acquiring intellectual property. The idea is partly to tie the value realized by the original asset owner to the future success and development of that asset within the public company. It also prevents the recipients of large blocks of stock from immediately dumping them onto the market, which could crash the price, especially for smaller companies. It promotes market stability.
Do escrowed shares still have rights, like voting?
The source notes that typically, yes, while the shares are held in escrow, the owner usually retains the right to vote them and receive any dividends paid on them. They just can't sell them.
Okay. Now, there's a specific program mentioned for small companies wanting to go public, especially on the TSX Venture Exchange. The Capital Pool Company, CPC, program.
Ah, yes, the CPC program. It's a unique Canadian innovation, really. It's designed as a streamlined way for entrepreneurs and experienced management teams to create a public company specifically for the purpose of finding and acquiring an existing private business.
So it's like creating a public shell company first.
Essentially, yes. Here's the process. A CPC is formed. It has experienced directors and officers, but no commercial operations itself. It just holds cash raised from its own IPO. It conducts this initial public offering to raise a modest amount of seed capital, and then its shares get listed on the TSX Venture Exchange.
Okay, so now it's a public company with cash but no business. What next?
The CPC management team then has a limited time, usually around 24 months, to actively search for and identify a suitable private company or significant business assets to acquire or merge with.
And when they find one?
Once they find a target and negotiate a deal, this proposed transaction is called the qualifying transaction, or QT.
Qualifying transaction.
The CPC then has to prepare a detailed filing document. It's similar in disclosure level to a prospectus providing full information about the target business they intend to acquire. The TSX Venture Exchange thoroughly reviews the proposed QT and the target company to ensure they meet the exchange's listing requirements for a regular operating company.
And if the exchange approves.
If the TSX Venture approves the deal, the qualifying transaction closes. The CPC combines with the target private business, the company usually changes its name to reflect the new operating business, and voila, the formerly private business is now a publicly listed company on the TSX Venture Exchange. It's essentially merged into the public CPC shell. Shareholder approval of the QT isn't always needed, which can speed things up.
Kind of like a shortcut or backdoor way for a private company to go public compared to a traditional IPO.
It can be seen that way, yeah. It offers an alternative path, especially for smaller companies that might find a traditional IPO too costly or time-consuming.
The source also mentions the NX board. What's that?
The NX board is a separate trading board, also operated by the TSX Venture Exchange. It's designed as a sort of lower tier for companies that were previously listed on the main TSX Venture or even the senior TSX, but no longer meet the minimum listing standards of those exchanges.
Why would a company end up there?
Maybe due to low levels of business activity, insufficient financial resources, or perhaps a CPC that failed to complete its qualifying transaction within the required time frame. It provides a venue for trading these companies' shares, but with lower regulatory requirements and visibility than the main boards. It's kind of a holding pen sometimes.
And briefly, crowdfunding is mentioned too.
Yes, crowdfunding is noted as another relatively newer method, particularly for startups and very small businesses. It involves raising smaller amounts of capital from a large number of individuals, typically online through dedicated platforms. There are specific regulatory rules and exemptions that allow for this type of fundraising, often with caps on how much can be raised and how much individuals can invest.
Okay, so we've covered a lot about how securities get created and sold initially, but selling shares to the public is often just step one. The next distinct process, you said, is getting those securities actually listed on a stock exchange, like the TSX or TSX Venture.
Exactly. Financing, underwriting, and listing are related but separate processes. A company can do a public offering without immediately listing on an exchange, though it's less common for larger companies, and listing requires a specific application to the exchange itself.
So how does that listing application work?
The company has to formally apply to the exchange they want to list on. This involves submitting a detailed application form or questionnaire covering everything about the company, its history, business, management, financials, share structure, distribution of shareholders, etc. The exchange reviews this information against its specific listing requirements.
And if the exchange approves the application?
If the company meets the criteria and the exchange approves it, the company then signs a formal listing agreement with the exchange. This is a binding contract.
What does the listing agreement require the company to do?
It obligates the company to abide by all the rules and regulations of the exchange on an ongoing basis. This includes things like meeting minimum financial standards, adhering to corporate governance guidelines, paying annual listing fees, and most importantly, complying with the exchange's continuous disclosure requirements.
We mentioned continuous disclosure before. What does that mean in the context of the listing agreement?
It means the company agrees to promptly file its quarterly and annual financial statements, immediately issue press releases about any material changes or significant news that could affect its stock price, and provide timely notice to the exchange about things like proposed mergers, stock splits, dividend payments, or changes in management. It's all about ensuring the market has timely access to important information.
So deciding whether or not to actually list on an exchange seems like a big decision for a company, with pros and cons.
Oh, absolutely. The source lays out several key advantages and disadvantages that companies weigh very carefully.
What are some of the main advantages of being listed?
A big one is prestige and goodwill. Being listed on a major exchange like the TSX carries a certain status, enhances the company's public image, and can make its shares seem more legitimate or attractive to investors, customers, and even potential employees.
And it provides a clear market value.
Yes, listing provides an established and visible market value for the company's shares, updated constantly throughout the trading day. This makes it easier for analysts to follow the company and for investors to track their investment. It also generally increases the marketability and liquidity of the shares. It's easier to buy and sell shares on an exchange compared to unlisted securities.
Any other benefits?
Listing brings excellent market visibility. Listed companies tend to get more coverage in the financial news media. Also, because of those stringent disclosure rules, there is generally more information available to the public about listed companies, increasing transparency. And a practical benefit. Having a readily available public market price provides a simplified valuation for tax purposes, which can be helpful for things like employee stock options or estate planning for shareholders.
Okay, sounds pretty good. What about the downsides, the disadvantages of listing?
They are significant too. Listing brings additional controls on management. Exchanges have rules about corporate governance, executive compensation, insider trading, related party transactions, etc. that management must comply with. There's also a constant need to keep market participants informed. This takes up a lot of senior management time dealing with analysts, institutional investors, hosting earnings calls, attending conferences.
I imagine poor performance is also more visible.
Definitely. That's the potential for market indifference. If the company isn't doing well, or if its stock is thinly traded and ignored by the market, that poor performance or lack of interest is very public, which can be demoralizing and potentially damage the company's reputation.
And the disclosure burden.
The additional disclosure burden from those continuous disclosure requirements is substantial. It requires significant internal resources, plus legal and accounting support, which costs money. And finally, there are direct additional costs. The initial listing fees charged by the exchange can be hefty, and there are ongoing annual sustaining fees just to maintain the listing.
So it's a real trade-off.
Yeah.
Access to public markets and prestige versus cost, scrutiny, and ongoing obligations.
Exactly. Companies have to weigh whether the benefits of listing outweigh these considerable costs and burdens.
Now, once a security is listed, the exchange doesn't just sit back, right? It monitors trading and can step in.
Yes, the exchange has the authority and the obligation to intervene and even withdraw trading privileges for a security, either temporarily or permanently. The primary reasons are always investor protection and ensuring a fair and orderly market.
How can trading be interrupted temporarily?
The source mentions two main ways. First, a delayed opening. This happens before the regular market opening time. If there's a huge imbalance of buy-or-sell orders that accumulated overnight for a particular stock, the exchange might delay the opening of trading in that stock to allow market makers more time to organize the orders and try to find a fair opening price. Prevents a chaotic open.
Okay. And the other temporary stop.
That's a halt in trading, which occurs during the trading day. This is usually ordered when a company is about to release significant news, maybe earnings results, a merger announcement, major discovery, something price-sensitive. The halt stops trading before the news comes out.
Why halt trading for news?
To ensure fair dissemination. The halt gives the market time for the news to be released broadly and for all investors to absorb the information before trading resumes. It prevents insiders or people who get the news slightly early from having an unfair advantage. Trading usually resumes shortly after the news is widely available.
Makes sense. What about longer interruptions, a suspension in trading?
A suspension is more serious. It lasts for more than one trading day, potentially indefinitely. The exchange might suspend trading if it has serious concerns about the company's financial condition, maybe questions about its viability, or if the company is failing to comply with its listing agreement, like not filing its financial statements on time.
Can trading resume after a suspension?
It may if the company resolves the issues that led to the suspension to the exchange's satisfaction. However, the source notes an interesting point. While some suspended stocks might find a way to trade on alternative unlisted markets, this is generally not permitted for securities that have been suspended by the TSX Venture Exchange.
Okay. And the ultimate penalty? Canceling a listing or delisting?
Yes, delisting is the permanent removal of a security's trading privileges from that specific exchange. Once delisted, it can no longer be bought or sold on that market.
Can a company choose to delist?
Yes, a company might voluntarily apply to delist, perhaps if it's being taken private through an acquisition, or sometimes if it feels the costs and burdens of listing outweigh the benefits. But delisting can also be initiated by the exchange involuntarily.
For what reasons would an exchange force to delisting?
The source lists several common reasons. The security itself might no longer exist. For example, the company went bankrupt or was acquired and shares were canceled. The company might become insolvent or cease to have any active business or significant assets. The public distribution of the shares might fall below the exchange's minimum requirement, meaning too few shares are held by the public to support a fair and liquid market. Or the company might persistently fail to comply with the terms of its listing agreement, despite warnings or suspensions.
Wow. So, okay, we've really traced the entire life cycle here, haven't we? From the very start, the fundamental need for a government or a company to raise money.
Through understanding the roles of the key financial institutions, the investment dealers, how they advise, the different kinds of securities, stocks, bonds, debentures, and those crucial distinctions, like secured versus unsecured debt, or authorized versus issued versus outstanding shares.
We covered how that capital actually gets raised. The methods, like government auctions using competitive tenders, private placements to big institutions, and public offerings, detailing those critical agreements like best efforts versus the riskier bought deal.
And then we really dove deep into that heavily regulated prospectus system, explaining why that full, true, and plain disclosure is so fundamental, walking through the process with preliminary red herring and final documents, understanding concepts like the passport system for cross-Canada efficiency, and those market out clauses.
Plus the streamlined short-form prospectus for established reporting issuers relying on continuous disclosure.
We looked at how dealers might try to support a new issue right after it launches using aftermarket stabilization techniques, especially that green shoe or over-allotment option.
We also touch on other routes to market, like junior company financings for risk capital, the purpose of escrowed shares, and that specific pathway for smaller companies using the Capital Pool Company or CPC program and the NE's board.
And then finally, we addressed the distinct but closely related process of getting those securities listed on an actual stock exchange, exploring the advantages and disadvantages that companies weigh so carefully when making that decision.
And finishing with how exchanges monitor trading and have the power to temporarily halt or suspend or even permanently delist a security to protect the market and investors.
It is definitely a multi-layered system. You can see it's governed by very detailed rules, involves many different players. But fundamentally, at its core, it's all about trying to channel capital efficiently from those who have it, the investors, to those who need it, the issuers, while simultaneously attempting to ensure fairness, transparency, and investor confidence through all that comprehensive disclosure and regulation.
And as you step back and sort of look at this entire structure we've just walked through, it really prompts a final thought, doesn't it? The immense effort, the complexity, the cost involved in this regulated financing and listing process. It provides crucial benefits, absolute transparency, investor protection, access to broad public markets, but it also clearly creates significant barriers, significant ongoing burdens for the companies involved.
A definite trade-off.
So the question to ponder is, how does this delicate balance this tension between protecting investors and the cost of compliance for companies? How does that ultimately shape which companies are actually able to access public capital markets? And consequently, how does it influence the universe of investment opportunities that are available to you, the investor? What does this complex dance between regulation and capital formation tell us about the fundamental values and priorities embedded within our financial system today? Something worth considering the next time you look at a stock quote.